Which makes a better investment, multifamily real estate or single-family homes? You've probably seen a lot of TV and media covering single-family homes. It's quite popular, but is there a better investment out there? In this video, I'm going to walk you through 5 reasons why you should consider investing in multifamily rather than single-family homes. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about multifamily versus single family. 5 things to consider. Reason number 1 is cash flow. There's several reasons why multifamily wins when it comes to cash flow. When I first started investing in real estate, before I knew where I wanted to go and before I had a long-term plan, I was acquiring and buying single-family homes. And one of the things I found is cash flow, the rental yield is extremely tight. Why is that? Well, with the single family home, let's say you have a single unit in there or even a duplex or a triplex. If you have one tenant move out in a duplex, there goes 50% of your revenue. That absolutely kills your cash flow. And then we have expense ratios. So with multifamily, because we have more units, the expenses are spread out over a larger number of units. So the ratio of expenses per unit goes down. This frees up cash flow. And then we have management fees. With single family homes, you can be paying 10 to 12% to have a professional management or a professional property manager. With multifamily, not only do you have on-site staff in the leasing office, maintenance staff, your management fees are significantly less, usually in that 3 to 4%. All this does is improve the cash flow you have. And let me tell you, when I owned a single family home, it was a duplex. We had a drain to the sewer a tree had gone through it, and it cost $9,000 to fix. $9,000 was basically 2 years of cash flow gone, poof, overnight with one repair. In multifamily, when you're dealing with larger properties, more units, more scale, the cash flow is there. It's a lot more cash flow positive. And in anything, cash flow is king in real estate. Without cash flow, the deal dies. Coupled with cash flow is number 2, which is stability. Multifamily is incredibly resilient and stable in economic downturns. CBRE did a study where they looked at the past 2 recessions, and multifamily outperformed all the other types of commercial real estate. There's a reason why lenders love lending on multifamily, because it's so incredibly stable. Why is that? Well, people always need a place to live. Businesses can close, office spaces can shut down, factories can close, but people still need a place to live. That is the last thing they will give up. And the government will do everything they can to make sure people don't have to give up their homes or their place to live. Multifamily is incredibly stable. Why? Well, we have the strong cash flow, which definitely helps out in the deal. You have much lower default rates in multifamily real estate because the cash flow is so strong. And then you have more units, more scale. Like I said before, if you have a triplex and a tenant moves out, there goes 33.33% of your revenue gone. Most businesses can't absorb that type of loss. But with multifamily, let's say you have 150 or 200 units, having 5 or 10 units vacant, that's not a big deal. That is just a cost of doing business. So the strong cash flow really supports it. And during the choppy waters of an economic recession or a downturn, multifamily comes out ahead. It has multifamily, generally speaking, has a shorter downturn in terms of rents dropping, and then it picks up a lot faster and surpasses the previous peak a lot faster compared with office, industrial, and retail real estate. Number 3 is valuation. And what this really means is control, which is the number 1 thing professional investors look for. When you're dealing with single-family homes, these homes are valued based on what's called the comparable approach. And I'll put a link right up here to a video I did explaining about how the comparable approach works. Basically what happens is, if you have 3-bedroom, 2-bath homes on a street and 3 of them sell for $500,000, well, chances are your home is worth $500,000. The bank doesn't really care about what you're renting it for. It doesn't care about potential rents. It doesn't really care about that. They're looking at what the comparable properties are selling for on the street. With multifamily and commercial real estate, it's valued using what's called the income approach. And I'll put a link right up here to the video I did explaining everything you need to know about the income approach. What does it mean in a nutshell? Well, the more net operating income or the more free cash flow that the property produces, the more our property is valued. So we can control the additional income streams we bring in, how we optimize expenses, how we raise the rents, and this gives us a really great amount of control over the value of our property. Rather than just waiting for Mr. and Mrs. Jones down the street to sell their house, we can really take an active role in forcing the appreciation of the asset. This is a huge thing that I wish I had when I first started investing in real estate. When I started doing the single family homes, I had no control over how the bank and the lenders valued my property. And number 4 is debt. When you're investing in single family homes, the lender looks at you first. You as the borrower, your income, your assets have to speak for themselves. The bank doesn't really look at the property itself. They want to make sure it's there. But when they're doing their underwriting and figuring out if you can afford the debt that's going on the property, the buck stops at you. So if something goes wrong in the deal, they're coming after you and all of your assets. Your income has to qualify. So even if the property is producing strong income, let's say it's a triplex or a fourplex, well, the lender is still looking at you, the borrower, to qualify for that debt, not the property itself. And when I was trying to scale my single family portfolio, this really held me back because the lenders have such a tight box they want you to fit in. But when we move over to multifamily, the lender looks at the property first and you as a borrower second. Sure, the lender wants to make sure you've got an experienced property management team on site and you have your business plan and you know what you're doing. First of all, they look at the property itself. Can the property support the debt? What is the property looking like? What's the business plan? That is the main focus, and this gives you a huge advantage as you're scaling your multifamily portfolio. Plus, with commercial real estate, we have something called non-recourse debt, and I'll put a link right up here to a video I did explaining the difference between recourse and non-recourse debt, which is simply something that I didn't have access to with single-family homes. And last but not least, number 5, we have tax benefits. Tax benefits are huge in real estate. And sure, we can use single family homes and residential real estate. We can depreciate those and get some tax benefits, but we really put depreciation on steroids in larger multifamily real estate properties. And the reason is cost segregation. And I'll put a link right up at the top to the video I did explaining about cost segregation. Basically what we're doing is we're taking 39 years worth of depreciation and we're front loading it right to the very start. So let's say this is 39 years. We push it all to the front. So it all comes down to the time value of money. $1 today in your pocket is worth far more than $1 tomorrow, 3 years, 5 years, 10 years, 15 years, even 39 years. Why wait 39 years for the property to fully depreciate when you can front load it and take advantage of the time value of money? Because of the scale and the size of the properties, it makes sense to do a cost segregation study and take advantage of the tax code that basically gives us huge tax credits just for acquiring real estate. Like I said at the start, I started off in my investing journey buying and acquiring single family homes, duplexes, and I really wish if I could go back in time, I would have started with multifamily right away. The scalability, the cash flow, the stability, the valuation, the control aspect, the debt you can put on the property and the tax benefits, they are all superior when you look at it. So like I said, if I could go back in time, I would be starting with multifamily. And if you're interested in learning more about multifamily real estate, join our free Facebook group. It's a great group of people, and I'll put a link right down below this video. And if you are an accredited investor and you're interested in learning more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel and I do appreciate it. And until next time, happy investing.